Economists, we got a couple of them here. And should we not cut? Joining us now, John Ryding, as a chief economic advisor at Brean Capital, believes the Fed should not cut rates. Andrew Hollenhorst, chief U.S. economist at Citi, and he thinks that the Fed should cut. I guess we just start by, I'll take a minus 0.5%. I don't care how we got there.
There were some revisions, though. Just it's unusually
okay, there were revisions,
large.
But
we don't usually see
because
revisions like this. I mean, it took it from 2.7 to 3.4 and 3.3 on the core for the prior month. So that's a lot bigger.
Where did that come? A lot bigger. Where did that come from? Well, we'll ask you guys. Ryding, where'd that come from? The revision.
Look, revisions are part of the economic data, not the CPI, which we got earlier in the week. That just doesn't get revised, but in the PPI. But here's the thing. You're talking April. April 2nd, the tariffs were announced. April 9th, they began to be implemented. Then they were all changed again for the most part. Companies have about a little more than 3.5 months of inventory on hand. So the stuff that's being sold is probably largely pre-tariff inventory. So people in the markets want to look at the data, want to see the impact. The impact's not going to show up for a few months. And that's why it's important for the Fed. We talk about its average inflation rates. It's faced an average inflation rate over the last 5 years above 3.5%. And it knows how it responded to the supply shock in COVID by continuing to ease, and that promoted inflation. They want to see what's the size of that price shock. Is that going to be transmitted into a higher sustainable inflation rate? And so it's just important to watch and wait. And let's remember, they cut interest rates by a percentage point between September and December of last year to recalibrate policy. I know they weren't expecting the kind of tariff increases that we had at that point, obviously, probably not even in March. So they have to wait. They can't lose the battle on inflation.
Understood. But it's interesting, Andrew, because in this case, and if the profit thing is right, I mean, anecdotally, I've seen the following. I've seen Hyundai and other automakers advertising, we will not raise prices. I've had Verizon reach out proactively and say, by the way, here's a new offer that we're going to let you lock in for a few years. None of that was happening during COVID, which tells me that the situation is dramatically different. And there's a sense, and we've seen this in consumer sentiment and so forth, that maybe the consumer is not, you can't just keep shoveling along these price hikes. So I don't know. And you think they should cut here?
Yeah, I think so, Kelly. I think the number that we should be focusing on is retail sales, which is down for a second month this year. It was down in January, down again in the control group in this month for April. And that's showing us that consumers no longer have the same spending power. Exactly to your point, demand is softening. When demand is softening, you should be a lot less concerned about inflation. So absolutely, I agree, John, they need to win the battle with inflation. But this is not an inflationary environment anymore. We have commodity prices that are down. We have house prices that have cooled down. And most importantly, wage growth has slowed. So COVID was an experience where we had a negative supply shock. There were supply shortages, and we had really strong demand. Now we're getting that negative supply shock, but not with that strong demand backdrop.
And people that hate the tariffs say they pointed out how much this could hurt growth with the uncertainty, with the companies not wanting to deploy capital and consumers not wanting to spend, and inflationary effects. They get to have their cake and they eat it too. They can worry about that. But when the inflation doesn't show what they were worried about, suddenly they abandon their growth concerns. I mean, it just seems clear to me if the inflation numbers are coming in a little bit weaker, and we're waiting for these growth effects, which are also lagged. Don't you think growth effects are lagged too? Why not preemptively do it?
Absolutely.
Why not preemptively do it?
Because easy money is not a substitute for a shortage of goods. Look back to 1973-74 and the oil price shock, which was a smaller shock to the economy in terms of cost.
I'm trying to understand what you're saying. So there's going to be, you think tariffs are going to cause a shortage of goods?
That's stagflation. And it may work out like you imagine it work out, Joe. It may work out like I'm forecasting. The truth of the matter is we don't know. And we don't even know what the tariff rates are going to be at this point because we're still in this renegotiation phase. The unemployment rate's 4.2%, which is right on top of where the Fed thinks full employment is. And inflation is too high. And yes, April, which is going to be a very noisy month, it is a bit better than we thought. But it's too soon to see what the impact of the tariff increases are. I paid in terms of stuff. If you have stuff come into the U.S., you pay the higher tariff. You have to pay UPS or FedEx to get those goods delivered, or they don't arrive.
Why do you say it's not? We're not in an inflation, Andrew. We're not in an inflationary. You basically said that we've almost conquered that bugaboo, right?
It's not conquered. We're still running above target.
But you're worried more about the other side.
Yeah, you just have to decide what are you more worried about. And I totally understand wanting to wait until all of this passes through the economy and we can see exactly what tariffs have done to the economy. But by the time you wait, this is what we learned during COVID. If you just wait and wait and wait, you will be too late. That's what happens. That's what happened in COVID when the Fed waited to see, is inflation going to be persistent? By the time they hiked, we already had persistent inflation. What worries me now is by the time they cut, do we already have a labor market that's weakening?
You guys are definitely on opposite sides. You've been pretty hawkish on inflation for a while, John, right?
Yeah, and as I said, look, the biggest mistake the Fed made, this framework review, well, not biggest mistake necessarily, but back in 2019, when I participated in the Chicago conference and was right when the first round of tariffs were announced against Mexico and Canada, the big was this average inflation forecasting, which led the Fed to respond too late. So we've seen an inflation rate of 3.5% for the last 5 years. And the public hates inflation. It's not positive for growth.
Do you think, and we got to go, but, and when you were talking about we don't know where tariffs are going to be, don't you think we're kind of in the deceleration of the trade war phase at this point and not in the, do you think we could get back to acceleration, Andrew? Or do you think, it seems like there's been a, I don't know, a bit of a, like that part of the administration, the Bessent side, the Elon Musk side, Navarro seems like he's been put on the back burner.
Yeah, that move over the weekend was surprising. We went into the weekend thinking 80% tariffs. We came out of the weekend with 30% tariffs, right? So you have to think things are de-escalating.
Like we're de-escalating. No,
de-escalating is one thing, but the post-war growth system was based on tariff reduction through GATT and the World Trade Organization. And the question is, how's the rest of the world going to respond to what the U.S. has done?
Right.